Good day, student. Welcome back to Pinard ACCA Learning. We're focusing on cost of capital, session 4. We're looking at irredeemable debt, which is a loan note, and redeemable debt, the convertible loan note. All right, let's start. Now, what is irredeemable debt? This is debt with no specific date fixed in advance for its repayment or redemption. It is expressed as the before tax interest or after tax interest as the percentage of the bond. Therefore, if we are trying to find cost of debt of an irredeemable debt without considering tax, it is I over PO. So let me write here without tax, where KD is the cost of debt, PO is the market value of the debt x interest. Remember the first part of the syllabus, we'll look at financial management function. I explained this com div, com interest, x div, x interest terminology. Remember, once you're going to solve for cost of debt, cost of preference shares, cost of equity using dividend growth model, what you normally use is x dividend x interest in the formula. That is the PO. So PO can either represent market value of shares or market value of the bond. But as I've said when I was teaching the terminologies, I told you if the examiner is silent about it, assume it is x div or x interest. So if it's without tax in the question, it is just simple. KD is equals to I over PO. Now the I is the interest payment, always calculated on $100 nominal value. YT is the tax rate that is given in the question. Now I need to emphasize the I here. The I is not the interest rate. Now what is this I? This I is usually the coupon that is given in the question, which is the interest. So we're talking about X and Y company issued a X percentage bonds, percentage bonds or coupon. That is the interest rate. Now to get I, you multiply that interest rate by $100. So if it's a 10% coupon or 10% interest, for example, you're saying AB co-issued a 10% loan note. It means 10% multiplied by 100. That gives you $10. That becomes I, not 10%. If you put where you're supposed to have I, you express percentage, i.e. 0.10, your answers will be totally wrong. It is in monetary terms. So 10% times 100, whatever percentage they give you, multiply it by 100. It's always calculated on $100 nominal value. Please take note. Now, you could be given the question, a tax rate. That means the examiner wants you to factor in tax into your calculation of what? Cost of debt. So, if you're going to factor in tax, the formula becomes I, open bracket, 1 minus the tax rate, close bracket, all over PO, which is the market value of the bond, x interest. So let me put this here with tax. Now let's see simple example. ACCA PICO issues an 8% loan note. The loan note is currently trading at $95. This is the market value per $100 nominal value. Require calculate the cost of debt. To calculate the cost of debt if the tax rate is currently 30%. So let's do the two. Now for the first one, it's simple. We say KD. Remember, no tax for this one, I over PO. Now, what it means is that cost of debt to be equals to 8% times $100 is $8 over the market value. They didn't tell us whether it is X interest or com interest. Because they are silent, we assume it is X interest. So just put a figure there, over $95, and that comes to cost of debt, cost of equity, cost of preference shares. Any cost of anything is always expressed in percentage, and if we do that, this should give us approximately 8.4%. Very easy. Now let's do the B part, the II part, which says we should factor in, assume a tax of what, 30%. So let's factor in tax, so that becomes KD net. Net means net of tax. I 1 minus T all over PO. So this becomes KD net tax rate is 30%. If I remove that from 100, which is 1 minus tax of that 0.3, you get 0.7. This divided by 95. If you use your calculator, this will approximately give you 5.9%. So you can see the introduction of tax made the cost of debt cheaper. So the tax here is given, this 1 minus T is a form of relief that is given on interest payment. So it makes debt cheaper. And as we've said before, or what we're going to say in subsequent sessions, that debt is always cheaper than equity. Now, one of the reasons why debt is cheaper than equity is because of the relief that is given on interest payments, and that is expressed as 1 minus the tax rate multiplied by the interest payment. You can see this without tax. We got 8.4, which is a higher cost of capital or a higher cost of debt. Then when we factor in our tax, you can see it has dropped to what? 5.9%. So it is true that the introduction of tax makes cost of debt cheaper. Now let's see for redeemable debt. So this one we just looked at is irredeemable, means there is no date for payment. But some debts, there could be date for repayment or redemption date. So let's look at redeemable debts. So this is a debt where the company that issues the debt will have to repay the debt at a date that was decided before the debt was issued. The cost of debt will be the discount rate that will be used when the market value of the loan is equal to the present value of interest payments and the redemption amount. So more or less you are saying that this is the rate where the MPV will be what? 0. What we're trying to say is that what is that rate where the market value, which I'm going to show you here, the market value, the present value of the market value will be equal to the present values, the total of all the present values of the interest payment, including the redemption amount. So we can only use IRR to explain that, or to calculate the cost of debt. Remember, I taught you IRR in the previous sessions where we dealt with investment appraisal. So you can as well go back to investment appraisal, or if you have not got into investment appraisal, you can want to skip this, go to investment appraisal, look at how to solve IRR questions, then you come back to this particular session. So the only way to calculate the cost of debt here is to use IRR, which is the internal rate of what? Return. Now this is the formula for IRR. I've explained that before in investment appraisal. Now what is the exam technique or the exam approach to this kind of question? Number one, the interest or coupon is always calculated on $100 nominal value. We've said that before. The I, which is the interest, is always calculated on $100 value. Number two, if the examiner is silent about the redemption amount, assume it is what? $100. If the examiner did not tell you how much the loan will be redeemed at, assume it to be $100. If the examiner does not give you the market value in the question, which is the MV, market value of the question, market value of the loan in the question, assume it also be worth $100. So if anyone is not giving you the question, either the redemption amount or the market value, assume them to be $100 in the question and move on. Don't think the question is not correct or is not complete. Assume it to be $100. Now let's see a simple question. It says ACCA issues a 10% loan note that will be redeemed in 3 years' time. At its nominal value, okay, they've told us how it's a 10%. This is the coupon rate. The 3 years loan note, it will redeem at its nominal value, which is what? This is at $100. The market value of the loan note is currently MV is $90. Tax rate is currently 30%, which is T. Calculate the yield. Sometimes you can call it yield. It's the same thing as cost of debt of the loan note. Alright, let's start. Now, remember the only way we can solve for redeemable loan notes is to use IRR. Irredeemable is the one we do I over PO or I1 minus T over PO if there's tax. That is for irredeemable. But once you see a period of loan where it will be redeemed at a point in time, you cannot use I over PO anymore. You must use IRR. That's the point. Now let's see. So let's use IRR. For IRR, you choose two rates you like. I've said if you need to go back to investment appraisal and revise IRR, then you come back here. Well, it's okay. Now you need to guess two rate. I like starting always with 10%. If I get a negative, I reduce my rate. If I get a positive, I increase my rate. What I'm trying to do is to get one negative and one positive. But I need to reiterate here that you don't have to get two positive or two negative. If you're very comfortable with your minus and positive sign in your solving, you can use two negative or two positive. You'll be within the range of the IRR like every other student in the exam. But for ease sake, I like having one positive and one negative. So let's move on. Now I'm going to use an annuity to make it faster for me. Yeah, 0 is a 3-year loan. I'm going to have description. I'm going to have cash flow. I'm going to have discount factor. I'm going to have present value. Then I'm going to rule. I'm going to have another discount factor. I'm going to have present value. I don't have to write the description out again so that it doesn't waste my time. But I'll show you a shorter way of doing this when I solve a constructive response question for you. But this is for you to understand what I'll be doing by then. Okay, let's see. Here 0 is the market value. The market value here, we say it is $90. Discount factor in year 0 is always 1. Now year 1 through 3, we have the interest. Remember, the interest is going to enjoy 1 minus T. So that will be, the interest is 10%, which is $10. So that will be 10, 0.7. And that will give me, that will give me $7. I just did 1 minus T multiplied by 10, it gives me $7. The tax rate is 30%, so minus 1 gives me 0.7, which is like 70%. It's going to be redeemed at its nominal value, so here we say redemption. Okay, now we'll go to the table because we're going to use an annuity. I'm going to use 10%. 10%. So I'm going to do 10%. 10% for 3 years. 10% for 3 years. That's 2.487. Let me come back. 2.487. If I multiply that by 7, that will give me 17.41. Okay. Now year 3, I'm not going to use an annuity because the figure is 100. I always use an annuity when the cash flows are the same. So what I'm trying to say here, it is $7 from year 1 to year 3. That's why I use an annuity. But since year 3 redemption is 100, I have to use the normal discount factor or present value tables for this one. So let me go there. So 10% for year 3, present value table. You can see present value table. It's present value table, PV table. Okay, so let's see 10% year 3, 0.751. That's it here. 0.751. So go here. 0.751. That will give me 75.1. So this will give me positive 2.51. Considering the $90 I have in year 0, just sum it up. Now that I have positive, I want to increase the rate so that I can get a negative. Being safe, I'll take it to 20% so that I'll be sure of getting a negative. So discount factor in year 0 is always 1. So this will still be $90. Okay. Now let's go to check 20% for year 3. An annuity, 20% for year 3, 2.106. So I go back, 2.106. If I multiply that, I will get 14.74. Okay. Then I will go to use present value now to check 20% year 3, 0.579. Come back, 0.579. Multiply this, I'll get 57.9. If I total this, definitely I'm going to get a negative, which is 17.36. Right, now that I have this, I can slot this in my IRR. Becomes IRR is equal to the low rates. Remember the formula: A, NPV minus NPV B minus A. You can also write it as, you see, IRR is equals to low rate plus NPV low over NPV low minus NPV, the high NPV high minus low. Okay, all right, can express it like this. It's the same thing anyhow you want to express it, whether you want to use low and high or A and B, whichever one you do, it's okay. All right, so let's go. The low rate here is 10 plus 10, oh, big bracket. The NPV of 10 is 2.51 over 2.51 minus, which is in the formula, minus this 17.36. I will now multiply the whole of this 20 minus 10. This becomes plus. Now if you put this in your formula and solve it, find out that IRR is equal to 11.26%. Therefore, it's safe for me to say KD net is equals to 11.26%. Very simple and very easy to do. If you want to revise your IRR in the under investment appraisal, you should kindly do that, please. Now let me give you a coursework to do. You know how we do it normally. You pause, try and solve it on a piece of paper, then play to see the solution and compare it with what you've done. Alright, I guess you did that. Now let's do it together now. Anderson Inc. issues a 7% bond, which is the coupon, expected to be redeemed in 4 years' time at a premium of 10%, tax rate is 25%. Calculate the cost of the bond. Now this is a 4-year bond. The other one we just did is a 3-year bond. So let's start. But this one is going to be redeemed at the premium of 10%. So if it's going to redeem at the premium of 10%, the normal redemption, the normal nominal redemption amount is $100. So if you put a premium of 10% on top, it will be 110. Now if you watch this question, no market value. Does it mean the question is not correct? No. Since there is no market value, it means automatically that the market value will be assumed to be what? $100. Remember the exam technique I taught you in the previous slide? It's going to be assumed to be what? $100. So let's solve. So see here, year 1, okay, sorry, year 0, year 1 to 4, then year 4. We have description, cash flow, discount factor, then present value, discount factor, then PV. This is market value. It's always 1 at year 0. So this is 100. Now we said this in the interest is 7%. That's $7. So the interest, this is $7. Now the tax rate is 25%. Now if you do 1 minus t on that, that's 1 minus 0.25. That will give you 0.75. And that will come to what? 5.25. Redemption. It's redeemed at a premium, so it will be 110. Very easy. So let's go and use the table. Remember, my favorite is always to start by 10%, but you can choose any two rates you like. I like starting with 10%. So let's see 10% for 4 years and annuity. 10% 4 years, that's 3.170. 3.170. So let's go back. 3.170 multiplied by 5.25, that should give you 16.64. So let's go and see redemption year 4, discount factor year 4, using present value table, 0.683. So I go back, 0.683. If I multiply that by 110, that should give me 75.13. If I total this, I'll get 8.23 minus. Now that I have negative, what I'll do is to reduce the rate so that I can get a positive. So I'll take it to 1. So you can see my movement is always, most times is 10. If it's positive, I increase to 20. If I get 10 negative, I reduce to 1%. So that I'll be sure I'll get a positive. That's what I'm trying to say. So discount factor in year 0 is always 1. So this is still 100. Now let's check 1% 4 years. An annuity. 1% 4 years, that's 3.902. So come here. 3.902. Multiply that by 5.25. That should give me 20.49. Now let's see present value table, 1% year 4. Present value table, 1% year 4, 0.961. So let's go there. 0.961. So if you do that, multiply that, you get 105.71. All right, if you total this should give you plus 26.2. Now that how it, you can easily slot it into the IRR formula. That becomes IRR is equal to 1, which is the low rate, NPV for 1% is 26.2 over 26.2 minus 8.23. This becomes plus. Minus minus is plus. This is 10 minus 1. Now if you slot this into the form calculator, this should give you 7.85%. So it's safe to say KD net is equals to 7.85%. Very easy, very simple. Now after this, I know you can solve any question as regard finding cost of debt. All right, thank you very much for listening to this session. My name is Andrew. The next session we'll be looking at more convertible loan note. Thank you very much. Bye.